Hi, and welcome to the final video in our Social Security Maximization course, a Yields for You Retirement Readiness course. In today's video, we're going to be discussing some techniques for reducing your taxable income in retirement. We're going to walk through your Social Security Maximization Action Plan, and we're going to talk about how do you turn everything you have learned into a retirement income plan. For those of you who don't already know who I am, my name is Leibel Sternbach, and I am the founder of YieldsForYou.com. We are an internet-based financial planning firm. What that means is that we don't sell products, and we're not looking to manage your assets. At Yields for You, we do two things, and we do them well. One, we teach people how to plan for retirement and how to stay retired. And two, we help our students implement those plans and keep their plans up to date as the times change. As I've mentioned in previous videos, there are three parts to this course. There is the theoretical knowledge, there is the maximization report, and the one-on-one strategy session. During the one-on-one strategy session, we take the theoretical information from the course and the maximization report, and we figure out how to best implement them in your life. Okay, let's get started. How do we reduce our taxable income in retirement? Remember, up to 85% of our Social Security benefits can be taxed. Our Medicare Part B premiums may be increased by the numbers on our tax return. And if we have 401ks, IRAs, or other qualified accounts, we might be sitting on a ticking tax time bomb, just waiting for us to hit 70 and a half. So, the question becomes, how can we defuse that ticking time bomb and keep as much of our benefits and retirement savings as possible? To answer that question, we have to first understand how Congress views taxes. The way I see it, there are three rules to taxes. Rule number one, Uncle Sam will always get paid. There is no such thing as tax-free, just a question of when you pay the taxes. Which brings us to rule number two. Uncle Sam is patient. He is very patient. He doesn't mind waiting 10, 20, or even 50 years to get paid, so long as he gets paid in the end. And rule number three, the rules are subject to change at any time. It seems like every president has some idea for how the tax system should be changed. Trump got elected and made sweeping changes, and you can bet that whoever's the next president, they're going to make even more changes. So the less of our money that is subject to taxation, the better I think it is. When we look at the world of taxes, there are really three buckets of taxable monies. The first is what I like to call the Tax Me Now bucket. Most people are familiar with this bucket. You earn money, it gets taxed. You have investments, when you sell it, it gets taxed. You pay taxes based on your total taxable income or gains. Associated with that Tax Me Now bucket is the Tax Me Later bucket. These are your IRAs, your 401ks, your 403bs, 529, health savings accounts, and other qualified accounts. These are the accounts that the government wants you to use to save money. They reward you for saving money by giving you an immediate tax deduction. However, when you do eventually take those funds out, Uncle Sam is there waiting for you. And just in case you thought you could get away with just taking the bare minimum, think again. Uncle Sam is going to force you to withdraw those funds at his schedule, not yours. So while you saved money while you were working and didn't pay taxes on those funds, when it comes time to use those funds, your good old friend Uncle Sam is going to ensure that he gets his pound of flesh. You're going to have to pay the piper someday. Which brings us to bucket number three, sometimes called the Tax Me Never bucket, though that's a little misleading. Like I said before, Uncle Sam always gets his pound of flesh. In this case, when you earned the money, you paid Uncle Sam. So you didn't get a tax deduction for putting money in this bucket, but the money in this bucket will grow tax-free. And since it is tax-free, Uncle Sam doesn't care how much you take or when you take it. So you get to control the flow and allow your funds to accumulate tax-free. This is the only bucket that allows you to grow and withdraw the funds tax-free. Every other bucket, you pay taxes on the growth. Of course, because this isn't the preferred method that Congress wants you to be using, there are some restrictions on when you can withdraw the funds and whatnot. But once you meet those minimum criteria, and you're in retirement and you've had it for 5 years or more, you can withdraw those proceeds tax-free. So, as we're in our earning and accumulation years, the majority of our assets will be in the tax me now or tax me later buckets, with perhaps a small amount going into the tax me never buckets. At least that's how most people are set up. However, as we transition into retirement, that tax me later bucket that was giving us a tax break while we were working suddenly becomes a very leaky bucket as the government starts poking holes in the bucket, making us take those mandatory distributions, forcing our savings and future growth to be taxed, and using that to tax our Social Security, reduce our eligibility for government programs, etc. So when we look at our retirement savings, what we really want is the reverse. We want as much of our assets as possible to be in the tax me never bucket, with as little as possible in the tax me now bucket, and only a small amount in the tax me later buckets. But unless we take action, this isn't the default path for most retirees. So how can we convert our tax me later bucket to a tax me never bucket? You can actually do it at any time. That doesn't mean you should, but you can. The government will allow you at any point to move funds from one bucket to the next. However, when you do it, you will have to pay taxes on the funds you move, which means that we're going to want to look at your earnings each year before December 31st and decide, is this a year when we'll be paying less in taxes than we will be in retirement? Is this a year when we have business or investment losses that we can use to offset our taxable income when we do that conversion? If the answer is yes, then we'll want to convert those assets, because that conversion will save us money and could potentially be tax-free. Of course, this isn't something that happens at once, and it takes planning. This is something we do for our clients each year, and it's something that you're going to want to start doing as you plan for retirement. Getting back to our original question, how do you reduce or eliminate taxation on Social Security? If you look at the chart on your screen, you will see a side-by-side example. Both couples are living on $67,000 a year. They both have the same investments. However, one couple is in the 22% tax bracket and will have 85% of their Social Security benefits taxed, while the other is in the 12% tax bracket and will have none of their Social Security benefits taxed, because they are below the income threshold for Social Security taxation. The only difference between the two is that one is pulling funds from the traditional IRA, from that bucket, that tax me later bucket, and the other is coming from a Roth IRA, which is tax-free and in that tax me never bucket. If you have questions or are interested in learning more about this process, in addition to our team here at yieldsforyou.com, there is Ed Slott, who is a CPA and has been called America's tax IRA expert. He has a website and has written a number of books on this issue. Just Google his name. As well as one of his students, David McKnight, who wrote an excellent book called The Power of Zero, which is all about getting to the zero tax bracket in retirement. If getting to the zero tax bracket during retirement is something that you're interested in, bring it up during our strategy session and we can discuss it in more detail. Now that we've talked about how to reduce your taxes during retirement, let's get into the fun stuff, your Social Security Maximization Action Plan. Okay, step number 1. If you haven't already done this, log into ssa.gov and view your statement. See if you're covered. Review your work history. Ensure it's accurate. If it isn't, contact the Social Security Administration. Find out about getting it adjusted, especially if you've worked after the age of 62. It will help increase your benefit amount. Step number 2. Let's generate your maximization analysis. We have a very nice online tool that's easy to use. Go to links.myfiduciary.online/SS or click the link. Go through the wizard. It will show you some basic options that you can explore. It will also tell you the maximum benefit you could receive. At the end of the wizard, fill out that information and hit send. That will send the data to me and my team so we can run a more detailed analysis. Once we receive that information, we'll print out your report and we will email to you and reach out and schedule your one-on-one strategy session. Or you can reach out proactively to us and schedule it. The information's on your screen. During your strategy session, we will discuss the various filing strategies available to you. We will discuss survivorship planning and how to account for the 50% reduction in benefits and help you decide what's the best filing strategy for yourself and your loved ones. Which brings us to part 3 of this video, retirement income planning. While we do teach a full 6-hour course on retirement planning, here's the 5-minute version. These are the factors that you should take into consideration when creating your retirement plan. First, ask yourself the following questions. Before you go too far down that rabbit hole, you need to know some of the answers to these questions. The big one is, when will you retire? Where will you live? What will you do? How will you spend your days? Will you travel for pleasure, to visit family, to get away from the wife? How much will it cost? Take some time and create a theoretical budget. Look up the costs and try to be realistic. Don't take shortcuts, like using a percentage of your current expenses. It may be tempting to use shortcuts, but retirement is very different. You won't spend your days commuting to work, and you're probably going to eat out more often than you do now, especially as you get older, and it's harder to cook. If you're leasing a car, it might make more sense to buy one. So really take the time and plan out what your retirement will look like, how much it will cost. The next question you have to ask yourself is, how will you pay for it? What are your assets? What are your liabilities? Create a balance sheet. Remember, you're running a business. Every asset and liability counts. Positive cash flow is important. We aren't Uber, who can afford to run $1 billion loss each year. That doesn't make us more money. Somehow Uber does, but not us. Next, we need to think about healthcare and long-term care. Those are the costs that we don't have today, but we will have one day. Medicare does not pay for custodial care. There are a limited number of days Medicare will pay for rehab or nursing home care stays. You break a hip, have surgery, you might have to foot the bill for the cost of recovery as you get older. As you get older, will you continue to live at home? Will you move in with family? Will you hire a home healthcare worker to come assist you during the days? Or will you move to an assisted living community? These are questions you need to start thinking about. There are private insurance policies or riders on life insurance policies that you can get to help cover some of these costs. Something else to consider is, how long will you and your spouse live? How long did your parents live? Are you in good health these days? These are factors that affect the assumptions you're going to have to make when planning for retirement. Once you have an idea of the answers to these questions, the next step is to take your cash flow statement and adjust it for inflation. Remember, costs are going to keep going up. What happens when one of you passes away? Make sure your plan accounts for the reduced income of survivor benefits. Have you factored in taxes and required minimum distributions into your cash flow? At Yields for You, we work to help our clients protect against the 5 major risks in retirement. Number 1 being drawdown. Drawdown is anything that brings down the value of your retirement nest egg, whether that is an explicit market loss or an implicit loss, like not claiming benefits you're entitled to, or spending too much money on taxes. All of these things serve to erode your nest egg, and due to the compounding nature of losses in retirement, losses right before or early in retirement can have a catastrophic impact on one's retirement savings. If you want to learn more about this, text me or Google the words sequence risk. Risk number 2, inflation. We discussed this before, but it bears repeating. Make sure that your retirement income is growing with inflation. Ensure that your investments are growing faster than inflation. Otherwise, you might get halfway through your retirement journey only to realize that your gas tank is hovering above empty. Remember, inflation is something that works for us during our accumulation years. But as we enter into retirement, it's that silent killer of our retirement savings. Which brings us to number 3, longevity, or said another way, the risk of outliving our retirement savings. As part of your retirement planning process, make sure you have a way to convert your nest egg into a paycheck for life. Or at the very least, ensure that you have a process to ensure your funds last through retirement. This means having a financial decision-making process, one that evaluates decisions based on these 5 risks, and it helps guide your critical decisions. Right? Which brings us to our last 2 risks. While we can do our best to plan for retirement, life has a way of throwing unexpected curveballs at us. And while we cannot stop life's unexpected surprises, we can at least plan and financially insure against them. Make sure your loved ones are protected financially from the unexpected and the inevitable. And above all, ensure you put in place a financial decision-making process. As long as you have a plan and a process in place that can address these 5 major risks in retirement, you will always know that you're making the strongest financial decisions for yourself and your loved ones. Okay, so just to review, your next steps. 1. Log into ssa.gov. Review your benefit statements. 2. Go online and get your Social Security Maximization report. 3. Schedule that one-on-one strategy session so we can go over the report and discuss how to take all that theoretical knowledge from the class and apply it to your life and situation. I look forward to speaking with you soon, and if you have any questions or if there's anything I can do, don't hesitate to text or email us at 516-400-4795 or email us at team@yieldsforyou.com. Have a great day, and remember, knowledge is power. Don't be afraid to ask the hard questions. Get the information you need to be able to retire with confidence and peace of mind. You only retire once. Get it right the first time.